What's up, guys? Eric here, Mr. Fired Up Wealth. I want to talk to you today about my top 5 ETFs. Now, there are a ton of ETFs, of course. I'm going to talk about my top 5 in my portfolio. It's a really good mix. And in fact, if you were to create a portfolio and not have individual stocks, you could probably get away with owning these 5 ETFs equal weight and probably outperform most people, in my opinion. The problem with a lot of ETFs is that they have the same holdings. So you look at the S&P 500, it's very tech, heavily tech weighted, which is fine, but it's important to try to balance that out with other dividend growth. And I'll explain here in a few minutes what I mean by that. With some ETFs like DGRO, which is a dividend growth ETF by iShares that you can get free trades on Fidelity, which is one I like. But let me jump right into this. So before we do that, what is an ETF? So an ETF, that stands for Exchange Traded Fund, ETF. It's a basket of securities that you can buy or sell through a brokerage firm on a stock exchange. ETFs are offered on virtually every conceivable asset class, from traditional investments to so-called alternative assets like commodities or even currencies. In addition, innovative ETF structures allow investors to short markets, to gain leverage, and to avoid short-term capital gains taxes. They also can be used as a hedged long-term investment tool. Simply buy and hold. You might have heard of what's called boggleheads. Someone that might have read this book right here, The Little Book of Common Sense Investing by John Bogle. John Bogle was the inventor and pioneer of the ETF with Vanguard. And some people do that. They just buy ETFs and they don't mess with individual stocks. I have a core position of ETFs, and I believe that most people should have at least 50% of their portfolio in ETFs. Some even have, quite a bit more. So keep going here. What is an ETF? After a couple of false starts, ETFs began in earnest in 1993 with a product commonly known by its ticker symbol SPY, or spiders, which became the highest volume ETF in history. There are now estimated to be over $1 trillion invested in ETFs and nearly 1,000 ETF products traded on U.S. stock exchanges. That's a lot. All right, so types of exchange traded funds. There are market ETFs. Those are designed to track a particular index like the S&P 500 or even the Nasdaq. We'll cover 2 of those. Bond ETFs, of course, it could be Treasury, corporate, municipal. There's lots of different bond ETFs. Individual sectors, so you could do oil, you could do pharmaceuticals, you could do tech, you could do whatever. There's even ETFs that are geared towards millennial consumption. There's ETFs geared towards Chinese tech, which would be a bad one at this point to buy with the current news. Commodity ETFs, of course, things like gold, oil, corn, silver. Style ETFs, they'll track a certain market capitalization focus. So it could be small cap, it could be mid cap, large cap, whatever you're trying to go after. There's foreign market ETFs, like maybe a Japan or Hong Kong. I have one that's actually a small cap India, ETF. So pretty much anything you can dream up, there's probably an ETF for it. There's even inverse ETFs. There's ETFs that are 3 times leveraged. So, you can do like a TQQQ, which would be the Nasdaq 100 bullish. You could do an SQQQ, which is short, meaning that you think that the QQQ or the Nasdaq's going to go down. There's again, anything you can dream up, they've got an ETF for. There's also actively managed ETFs, which is, basically designed to outperform an index, where there's a portfolio manager that will buy and sell actively, and it doesn't simply just, go off of a tracked asset class and not, have movement in or out. Those are becoming more and more popular. I haven't really found any that really outperform just, buying a straight S&P 500 index fund, but maybe someday. Everything is cyclical, so you never know. Exchange-traded notes, in essence, debt securities backed by the creditworthiness of the issuing bank, created to provide access to liquid markets and have the added benefit of generating virtually no short-term capital gains taxes. That's one reason that people like ETFs, because they can simply buy and hold for a long time. And then there's alternative investment ETFs, so innovative structures such as ETFs that allow investors to trade volatility or even gain exposure to a particular investment strategy, such as currency carry or even covered call writing. And some of this might be, more than you care to know about, or you might not know what I'm talking about on those. All you really need to know is ETFs. Essentially, they're traded just like a stock on the exchange. It's liquid, so you can buy and sell it. Versus, say, a mutual fund. A mutual fund, if you wanted to sell your mutual fund, you would put in an order, say Monday at 1 o'clock in the afternoon, and that's not going to get processed till after the market's closed. So the market's closed, and then your broker that owns the mutual fund will essentially, crunch the numbers, and then they'll pay you out based on what the closing day price is. So it's not, happening live, like an ETF is. You can trade it just like a regular stock, during regular business hours when the stock exchange is open. What are the advantages of ETFs? Well, buy and sell, again, anytime the same day. Mutual funds, in contrast, settle after market close. I just discussed that. Lower fees, so there's no sales load, meaning a lot of mutual funds, you'll have a 5% sales load. So say you put in, $100,000, that's a lot of money, but say you put in $100,000 and you had a 5% sales load, the broker would actually take 5% or $5,000 in that case, and you would only be investing $95,000. And that was common before ETFs were invented, and it was a way a lot of people lost a lot of capital. So ETFs are much more cost effective, a lot less expensive. There's usually a brokerage commission applied to it, like a $4.95 if you're with the Fidelity. But for example, if you're with Fidelity, there are no brokerage commissions for iShares or any of the Fidelity ETFs. If you're with Vanguard, of course, there's Vanguard that they have ETFs that are no commission, and Schwab has the same, and so on. Again, more tax efficient. Investors have better control over when they pay capital gains tax. That's important in a taxable account. Most of my assets are in a taxable account. Therefore, ETFs can be a great strategy. One thing I want to point out on that, and one thing I've ran into if you have a taxable account and you're holding money in these ETFs, it's very important to know which ETFs have qualified dividends. The QQQ, and every year it's been different, but for example, like an IVV, I believe it was 97% last year was qualified, meaning that only 3% you would have to pay any tax on. The QQQ was much different. A large percentage of it was unqualified, which makes me scratch my head. And I called Fidelity and asked them why, and they couldn't even really give me a good reason. It makes no sense because they're U.S. companies, which should, if there's any dividend in there, it should be qualified. But there are some foreign companies supposedly in there. Not exactly sure. Again, I called Fidelity and didn't really understand. But you have to be careful with ones like QQQ and just be aware of it. I'm just bringing it to your attention to be aware. If you have a taxable account, not all ETFs are created equal, and just make sure that they have qualified dividends. You probably have to, not only look on the website for each company that you're investing in, or each, brokerage fund, so in other words, Schwab or whatever, but it's also good to call the actual broker and talk through it with them and make sure you understand before you invest too much money in it. And a thing like QQQ, it pays less than 1% yield, so unless you have a ton of money in it, it's really not going to make a big difference. But the more money you have, of course, the more it impacts your bottom line, and it can add up over time too, over 20, 30 years of holding. Trading transactions is another advantage because they are traded like stocks. Again, investors can place a variety of types of orders. So you can do a limit order, you can do a stop loss order, just like you can with a regular stock. You can buy on margin, and that's not possible with most mutual funds. Actually, none that I know of, but I'm sure there's one out there because there's always some. There's always one of everything, it seems, but most mutual funds do not have that capability. What are the disadvantages? Trading costs. If you invest small amounts frequently, there may be lower cost alternatives. Because some of these mutual funds won't have fees if you do smaller amounts. But in most cases, especially if you're doing a no commission ETF, say you have a Fidelity and you're investing in iShares, you can literally buy one share and there'd be no commission on it. So it just depends on your situation. Liquidity, some thinly traded ETFs, and you'll find this a lot with, like, say, the marijuana ETFs, especially the new ones like YOLO, and like there's a few of them actually out there. That Seymour's got one, Nigerian's got one. But when there's low liquidity and they're thinly traded, you'll be buying at the high price of the spread and usually selling at the low price of the spread. If you're a buy and hold investor, this isn't as relevant, but if you're using it as a trading vehicle, it is very relevant. Tracking errors, while ETFs generally track their underlying index fairly well, there can be technical issues that create discrepancies. You've probably seen, grades on ETFs, which will essentially grade the tracking error. So if you go to Morningstar, you go to, ETF.com or whatever website you use, they usually rate it, and a lot of that rating is based off the tracking error and how well it tracks, the index it's supposed to follow. And then settlement dates, ETF sales, and this depends on your brokerage again, but oftentimes they're not settled for a couple days after the transaction, and that means as a seller, your funds from an ETF sale are not available for a couple days to reinvest. Not really an issue, again, at least for me in Fidelity, I don't have that issue, but some brokerages do. And again, if it's a buy and hold type strategy, you probably don't care that much because it's not like you're buying and selling very often. You might buy all the time, every week, every month, whatever, but you might not sell it for years at a time, so you might not care as much. All right, so let's just jump into my top 5. So number 1 is going to be IVV, and that is an iShares by BlackRock. Again, it's with Fidelity, there is no commission on that one. This basically tracks the S&P 500. It would be very similar to the SPY, or VOO if you're a Vanguard person, that's VOO. IVV is simply the S&P Core 500 from iShares, and if you're with Fidelity, it makes a whole lot of sense because you can buy this without paying the $4.95 commission fee. So this one, I'm not going to spend a lot of time on it. It's pretty straightforward. All these are pretty reasonable for managing the management fee expense ratio. You're paying a 0.04% expense ratio. This is pretty good. Some of them are even a little less than this, but you'll see some of the, exotic ETFs like, the cannabis ETFs, you might pay up to 1% expense ratio. It's still a lot better than some of those old school mutual funds where you paid 5%, load fees on. Those are crazy. Here's the top 10. Pretty straightforward. Microsoft, obviously biggest, company, Apple, Amazon, Facebook. You can kind of read this list here. Procter & Gamble, Johnson & Johnson. Now, if you go into the detailed holding, this is basically S&P 500. So again, we're not going to want to spend a whole lot of time on this. But just to give you an idea what's in here, you see Coca-Cola, Boeing, all the S&P 500 are going to be in here. So all the way down, and the lowest position in here, they've got some cash, they've got News Corp, Coty Inc., etc. But the majority of this, if you look at the weighted percentage, these are your top 10 holdings, and you've got 4.3% in Microsoft, almost 4% in Apple, you've got almost 3% in Amazon, and so on. So a big chunk of this, again, is going to be FANG, and this is why a lot of people don't like, or why a lot of people like to diversify outside of the S&P 500 because of that tech-heavy, FANG type weight. Some people, especially value investors, do not want to have too much exposure to that in their portfolio. Number 2 is going to be QQQ, and this is going to track the Nasdaq, primarily the Nasdaq 100. This is going to have a little bit higher expense ratio. It does pay a yield of about 0.7%. And just to backtrack on here, the IVV does pay a yield. It's right around 2%. So you will, distribution yield is 2.48 as of August 30th. The 30-day SEC yield is 1.89. So you're getting roughly a little under 2% on your yield. QQQ, last time I checked, is like 0.7. It's pretty low yield, but you are getting some dividend payment on that. So Microsoft, again, interestingly, is also, this is tech heavy. And so here we go again. Now we're going into the Nasdaq 100, and Microsoft, again, you first. You see Apple again. But you'll notice how, now it's Intel. You're not seeing Amazon right away. So it's a little bit different breakout, and it's going to have a lot more tech companies that you won't see. Like here's, NetEase. This is Chinese, an ADR. JD, another Chinese ADR. It's got O'Reilly Automotive. It's got Wynn Resorts. It's got, some pharmaceutical, biotech. like Celgene and Amgen and Biogen, IDEX Laboratories, and so on. But your major weightings are, going to be tech. Texas Instruments, you got chip, Broadcom chip, NVIDIA chip, Qualcomm chip, PayPal, FinTech, Adobe, subscription software, Cisco. This is one of my favorite stocks right now. I love Cisco. Wish I had even more shares than I already own. Apple up there, et cetera. So QQQ is number 2. Number 3 is going to be DGRO that I talked about earlier, and this is based on it's a low-cost exposure to U.S. stocks focused on dividend growth. So that means companies that increase their dividend payouts or they grow their dividend payouts on an annual basis. And if you look at this one, it's going to also pay a dividend yield. The dividend yield on this one is a little bit higher than the S&P 500. So the 12-month trailing yield is about 2.28%. The distribution yield is 2.45%, again, based on August 30th of 2019. The fees on this one are slightly higher at 0.08%. The QQQ is also more than the IVV. This one's just a little bit higher because there's a little bit more work that goes into this one than the S&P 500 index. But here we go again, guys, Microsoft and Apple. Well, that's the same as last time, but then it starts to change up. Now we got Verizon. Well, that's because Verizon's a good, DGI, and it has a nice yield. JP Morgan Chase, financials, Johnson & Johnson, Chevron, Wells Fargo, more banking. In fact, if you look at it, financials are 19.37% of exposure. Healthcare is 15.44%. IT is 15%. So let's just look at the exposure on the IVV. Information technology is almost 22%, and then it goes healthcare and then financials. So you see the difference, pretty big difference. Healthcare is number 2, financials, technology, industrials. So this, in my opinion, really helps balance out your portfolio because now we've got a lot different holdings than we had in even the first couple that we looked at. And let's look at a detailed breakdown of DGRO and see what else we can find inside of here. So there's Merck, Pepsi. Hey, I like these companies. Boeing, yeah, why not? Walmart, Disney. There's Texas Instruments again, U.S. Bank Corp, BlackRock, Target, on and on. These are all great DGI companies. So if you follow DGI, if you're a DGI investor, you probably own a bunch of these already. This just kind of takes a lot of the guesswork out of it and gives you a really hedged exposure with a decent dividend. In my opinion, though, it's not as good a dividend, and that's why I like the next couple. So VYM, this is a Vanguard high dividend yield ETF, and this one has an expense ratio of 0.06. So you're seeing, they're all like under that 0.1% expense ratio, which is still really good. And you got, let's just look at JP Morgan is number 1, Johnson & Johnson, Procter & Gamble, Exxon. You'll notice that the DGRO, the last time I checked, I'm pretty sure on this, has no REITs, so no real estate investment trusts in it at all. And that helps with the qualified dividend. And that can be an issue for some people, not with others. But you can see here, this is another one where it's basic materials, consumer goods. You don't see real estate listed on here. Go back to DGRO, and real estate is 0.04%. So there's not a lot of REITs, which is why I like it. Again, oil and gas, there is some exposure here. So some of this might be MLPs and things like that. You won't have to do a K1 like if you did if you own the individual stock, but it will impact the percentage that's going to be qualified. So your broker is actually going to break it down for you in the tax statements at the end of the year and say, this particular ETF was 90% qualified, which means you have a 10% exposure to non-qualified dividends, and you'll pay accordingly to that. So portfolio holdings, let's take a look at this in more detail. This is VYM, again, Vanguard High Dividend Yield ETF. So we already went through the first ones, but you can see 3M, Qualcomm, Lockheed Martin. You're seeing a lot of the same names over and over, and a lot of these names, again, are in the S&P 500, and a lot of them are even in the QQQ, but it's different distribution and percentages and how they're weighted within it. And there is some different exposure. All right, guys, so there you have it, my top 5 ETFs. So again, it is IVV, that is the iShares Core S&P 500. The Invesco product of QQQ, which is the Nasdaq 100. That's primarily information technology and tech and the high flyer, high risk, high reward type sector. You have the DGRO, which is another iShares, BlackRock iShares. and this is for dividend growth, a focus on dividend growth. Stock ticker is DGRO. And then you have the Vanguard VYM, which is the Vanguard High Dividend Yield ETF. And finally, the Schwab US Dividend Equity ETF. Those 5 are, in my opinion, the best 5. There's obviously a ton of other ETFs out there. For those of you that are interested in the marijuana sector, there are a ton of ETFs. MJ, which that's more Canadian exposure though. There's a YOLO, ticker, YOLO. There's a bunch of new ones like HMUS, if your broker has that one, which is primarily US based cannabis companies. There's a ton of them out there. If you have questions on the MJ related ETFs, feel free to message me, leave a comment, hit me up on Facebook, whatever. We can talk about those. But when you're looking at just exposure for your core portfolio, something that you're going to buy and hold and continue to add on a weekly, monthly, basis, and continue to hold, through thick and thin, these are the core to my portfolio that really I'm never going to, sell until I need the money. You would have a core position of these ETFs or a combination of whatever ETFs you like. There's a ton of them out there. And then, of course, the individual stocks are a way to kind of play the market to see if you can outperform it. I will tell you from experience that most people, and you'll hear this from, the Boggles of the world, the Buffetts of the world, Kramers, whoever you like, dislike, it doesn't matter. They're all going to tell you to invest in, the S&P 500 index fund. So if you're not sure on these other ones, throw your money in the S&P index fund, IVV, or the SPY, or the VOO. And if you don't like investing in individual stocks, you're probably going to be safe on that. That's something that, as long as the U.S. continues to grow and continues to flourish over time, this is going to always be worth more money. The only way it wouldn't happen, like I've said before, is if there's a zombie apocalypse or some kind of war. There's anything can happen. Nothing's risk-free. But if you want something that is as risk-free as you can get and still have good returns, the S&P 500 is really where most people are going to tell you is where it's at. So if you have a long-term horizon, it's not a bad idea to have a significant part of your portfolio and something like an IVV, and to continue to let it grow and to let it drip. The investments or the dividend investments being reinvested back into more shares. And most people like to buy every paycheck, every week, every month. Don't worry too much about time in the market. Just, put in whatever you can afford every paycheck, and whether the market's up or down, it's going to balance out in dollar cost average. Some people that are really active with their management skills, they can try to time it better, put the money into a sweeping account within your brokerage and let it sit there until the market dips and then put money in. Some people do that. There's a million ways to do it, guys. But if you're talking about the casual investor that wants, stress-free, I get people message me all the time. I want to start investing and I've got, a couple $1,000s, but should I wait? Is the market going to go down? Does it really matter if you've got a 20-year horizon? Just throw the money in and invest, consistently so that you're getting a dollar cost average on purpose, just through the way that you're investing by doing it, weekly, bi-weekly, monthly, whatever it is, whatever you can afford to do. So anyway, guys, if you haven't subscribed, please do. Bottom right corner, hit that subscribe button. There's a little bell on there. Please click that. Make sure you get notified. I try to make at least one video every week. I'm working on another video right now that's going to be the top 10 holdings for the next 10 years. That is what the Fired Up Facebook group has requested. We do a video poll every couple weeks to kind of decide what's next. If you're not on our Facebook group, I encourage you to go onto Facebook and do a search for Fired Up Wealth. We have a page and we also have a private group. If you like the page, you'll automatically get an invite to the private group, and we have a lot of great discussion in that group. A lot of really good investor minds in there, and we encourage you to join us. So anyways, thanks for watching this video. Hope you found it helpful, and hope you have a great rest of your day. Take care.